Good afternoon. My name is Jackie Dzelski. I'm President and CEO of the Manatee Chamber, and we are thrilled that you are joining us either live online for our webinar today on the Employee Retention Tax Credit, or some of you may be viewing this after the fact through our recorded library of webinars. And we feel a deep sense of responsibility to bring this type of information to the business community here in the greater Manatee County region, thanks to the expertise of members, including Christy and Anne Marie, who you will meet in just a minute. So I do have a disclaimer, maybe no surprise given the topic today, that the material presented today on the Employee Retention Tax Credit is based on the laws and the regulations and the rules as they're known as of today, and they could certainly change in the future. And so, as our advice always is when we're touching financial or legal or HR issues, is please, you are encouraged to consult with the financial advisors, your lender, your accounting professionals, the attorneys that advise your business to see where and how the eligibility for this program in particular impacts your business. For those of you that will hear terms like PPP during the webinar today, I wanted to draw your attention to the fact that next week we'll be hosting another live webinar on the Paycheck Protection Program, what round 2 looks like, and some of the tax implications beyond the Employee Retention Tax Credit that are associated with the PPP and EIDL and other assistance programs. And so with that, I am going to introduce you to Anne Marie Sale, CPA and partner, as well as Christy Cardillo, CPA and partner with Carr, Riggs, and Ingram. And we are thrilled to welcome them. I do want to give a shout out as Christy and Anne Marie are preparing to the sponsors of the webinars that the Chamber brings to our members in the business community, and that is Lepensi Pools, Plumbing, and Air, as well as Veritas Pest Management. Thank you very much to those 2 organizations, Chamber members, who make it possible for us to continue to bring a very rich lineup of webinars to our members. So with that, I am going to drop off the screen and turn it over to Christy and Anne Marie.
Thank you, Jackie. We appreciate that introduction. So Anne Marie and I are going to try to do our best today to share with you about the Employee Retention Tax Credit and help you figure out if your business qualifies or what you need to do to figure that out. We are with Carr, Riggs, and Ingram, and I am going to share a little bit about each of us. So Anne Marie, do you want to share your slide? We have these bio slides, so we have to share them.
These are kind of just fun, lighthearted to get us to know us better. Clearly, these aren't the top resume items, but I do enjoy, I did go to school at FSU. I also went to Florida. The firm chose to put FSU. I'm not sure why. I root for the Gators, just like Christy. But yes, I am actually born and raised in Panama City in the Panhandle in a different time zone, but still in Florida. I am here in Panama City today, and it's beautiful. I did go to school at FSU and UF. I do enjoy getting some movement time in outside of work. And then my kids, I have 4 children. They enjoy soccer and sailing. So we do a little of both, travel for those things. And we do have a sweet Molly that is our English Cocker Spaniel.
Thanks, Anne. And then I'll share mine. I am here in Bradenton, Florida. And like Anne, they chose to use my University of Texas graduate degree, but I also went to UF. I enjoyed traveling around the US, maybe not so much in the last year, but I do like going around and seeing especially historical sites and watching the Florida Gators. And I have 2 children as well. Some of you may know them in the community. And I have 1 dog, Bella. She is the long-haired Chihuahua, and she's the #1 main troublemaker in my house. So with that, we're gonna go ahead and I'll give a quick overview, and I'm gonna hand it over to Anne to do the first couple of walkthrough basics on our ERTC. We're hoping that what you gain and the knowledge that you gain from being here with us today is understanding what the credit is, who's eligible, what are considered qualifying wages. There were changes that were made at the end of December that were made from 2020 to 2021. And what are those changes? What does a business need to do to apply for the credit? How can you take advantage of it? And how does it interact with some of the other relief provisions that are out there being claimed right now? So with that, Anne, I'll let you go ahead into sharing about ERTC.
Sure. So ERTC, we can call it retention credit, ERTC, but regardless, it is a credit. It is a tax credit. It reduces your taxes. It doesn't reduce your income taxes. It reduces your payroll taxes. So you can see the first bullet point here is a refundable payroll tax credit. So it does require that there are wages involved, employees involved. This is not related in any shape or form to contract labor or 1099 employees. This is your traditional W-2 employee. I do want to say that everything we're talking about today relates to COVID. There are many forms of retention credit. I was hit by Hurricane Michael in 2018, Cat 5 hit the panhandle, wiped us out. We're still dealing with it. And I can tell you we did a lot of returns with retention credit on it. Don't forget that is available. But the webinar today is retention credit as it relates to the pandemic and COVID. And so some of the qualifications are to be included as an eligible employer. And there's many different definitions of wages and employers and types of businesses, and we will go through all of that. But the most basic of points is this first 2 bullet points that you must either have a full or partial shutdown related to governmental orders. We'll talk about what those are, or experience a decline in your gross receipts during any particular quarter. You may be wondering, why have I not heard about this? Why is everybody talking about PPP, but nobody's talking about retention? There's a reason for that. PPP and retention, this form of retention for the pandemic, came out at the same time. However, PPP was bigger, better, faster, prettier, more popular. It was that form of a grant. Many of you probably received PPP, but the retention credit was before December 27th, not available with PPP. I was chosen in the firm to write the article for the firm on retention credit. Nobody read it, nobody cared, nobody liked me because they wanted PPP. But that changed, and on December 27th, a new law was passed that overlapped that previous CARES law that made this retention credit, this payroll tax credit, more advantageous for businesses because it allowed you to claim it related to those that also got PPP. So this law change allowed the credit to not only happen for 2020 with PPP, but also into 2021. And so far today, it's through 6/30/2021. Now these rules are different, and we will continue on to the next slide and talk about, the differences. This slide right here is talking about the eligible employer. And again, like I said, there has to be either a full or partial shutdown or a significant decline in gross receipts. When I say full or partial shutdown, it does require that it be due to a governmental order. This is not just, I was scared, I didn't like COVID and I shut my business. No, it's a government order related to a government order. Significant decline in gross receipts. This is one of the 2 tests. Obviously, if you were shut down or required to shut down, you don't have to meet this test. And if you don't have to meet this test, the measurement period for if you qualify are those days you were shut down. So if you were only shut down for a week, it would only be qualifying wages in that week that you were shut down. This is a test, and I want to stress the fact that this slide right here relates to 2020. So there's a different rule for 2021, but for 2020, if you had a significant decline in gross receipts, it means a decline of 50% in your gross receipts. So and this is a quarterly. So some businesses keep monthly financials, some keep quarterly, some don't. So we are right now helping clients try to pull their revenue, their gross receipts, their top line, not net, but top line revenue, to see if they had a decline in gross receipts. And you compare quarter to quarter. So you pull your 2019 financials out. You look at them for each quarter in 2019, and you compare them to 2020. And if any quarter, Q1, 2, 3, or 4, had a decline, then you potentially qualify as an eligible business for the retention credit, assuming you weren't shut down. Let's go to the next slide. I think we have an example. This is hard to read, but I'll tell you what it says. And if you could read it, you might get confused, to be honest. When I first read it, I almost called Christy and was like, this is not good, this is not good. So this example is listing just a specific quarter one had 100,000 in gross receipts, quarter two, 190, quarter three, 230. And it's wanting you to compare those first 3 quarters of 2020 as compared to what happened pre-COVID. So pre-COVID was 2019, and you grab those quarterly revenues of 210, 230, and 250 for the year 2019. And you're comparing 2019 to 2020. And if there was a decline for the 2020 credit of 50%, then you get to qualify for the retention credit. This example mentions something about there was a significant decline, and it talks about comparing the quarters, and it mentions 48%, 83%, and 92%. Well, it's really 52%, 17%, and 8%. So if you think about it that way, there was a decline of 52% in this example. So because Q1 in March, they had a decline of 52%, that means that quarter qualifies for the retention credit. I'm not sure I covered this well, but I will read this to you. It says that you get the credit in the quarter where there's a decline of more than 50%. And then it lasts, quote, until the first day of the first calendar quarter in which gross receipts are more than 80% of the gross receipts for the same quarter in 2019. That makes my head spin. My point in telling you, if you meet one quarter, you're going to meet the next quarter. And to continue to meet on into the other quarters, you can't have, you only have to meet a 20% test is the best way I know to explain it. But, first see if you have that decline, then we'll talk about when it ends. All right, let's go on. Everything I've talked about mentions a payroll credit, and the payroll credit for 2020 mentioned 50% decline. Well, how much is this payroll credit? For 2020, it equates to about $5,000 per employee. You might say, that sounds great. And I have a lot of employees, and that's a good benefit. What will really shock you is the change that they made for retention credit for 2021. Instead of having a 50% decline, you only have to have a 20% decline. So that measurement test of these quarterly declines has really reduced for 2021. You still get it for 2020, but to meet that 2021 test, it only has to be 20%. So you would look to the quarter one, 2021 as compared to Q1 2019. And if you had a 20% decline, you are eligible for this credit. The law does allow you to choose the quarter before. So you could actually run the test right now. You can use 12/31/2020 as compared to 12/31/2019. And if you had a 20% decline, then you meet the test for Q1 2021. So it still has that same rule about when it ends. Pretty much if you qualify for the first quarter, then you automatically get that next quarter. Now let's go to the next slide. I want to reiterate and explain how much better 2021 is for you. So not only do you only have to meet the 20% test instead of the 50% test, they really expanded the retention credit for 2021 to allow it to be $7,000 instead of $5,000. And instead of per year, it's per quarter. So the total credit for 2020 can be a max of $5,000 per person, but the total credit for 2021 could be a total of $14,000 per person. So, and potentially even more if they continue to extend it. Right now, it's only through June. So, you know, when you start talking 14,000 for 2 quarters, that's pretty big per employee. There are some funny ways they describe the credit. It does talk about qualified wages being the first 10 grand of wages, and then you multiply it by 70% for ERTC 2021 and only 50% for 2020. Those, and we'll get to it, really matter for purposes of PPP. We mentioned at the beginning of this that PPP was more popular, and Christy's going to go over some of this in a bit, but you know, while we can take both now, you can't use the same set of wages for PPP, Paycheck Protection Program grant, and the ERTC, the retention credit. So you just have to be careful to understand the rule about qualified wages so that you know what wages are kind of earmarked for ERC that then are eligible for forgiveness for PPP later on.
So this is talking about what are qualifying wages, or what causes qualifying wages. So for the 2020 law and ERTC, if an employer had more than 100 full-time employees during 2019, the qualified wages, which Ann already explained that they need to be W-2 wages, include healthcare costs. So you can add the healthcare costs. It is up to $10,000 per employee, paid to employees that are not providing services because operations were suspended due to the decline in gross receipts. These employers that have more than 100 full-time employees, they can only count wages up to the amount that the employee would have been paid for working an equivalent duration during the 30 days immediate preceding the economic hardship. Okay, so if they're not working, then you can't give it to them. But if they're you can use it for them because if you're shut down. If they are working for you, then you cannot use it if you have more than 100 full-time employees, meaning providing services. If the employer has an average of 100 and fewer, which for most of the small businesses within the chamber, that's what you fall under. During 2019, the qualified wages, there's the same thing. They're the wages that include the healthcare costs, same max up to $10,000 per employee, paid during the period operations were suspended or the period of decline in gross receipts. And it does not matter whether they continue to work for you during that period or whether you were closed down and they were not able to provide services and work for you. So you can use it either way. So you don't have to worry about that, but we want to make sure that you know where that bright line number of employees would be, because we do have employers with more than 100 people in our area. And this only applies to the 2020 payroll quarters. Now, when you move into 2021 for qualifying wages, they changed this. And they did it to provide the opportunity to more employers to, whether the employees are continuing to work for you, kind of like how people still worked while you had PPP money, because that was to cover their payroll. With this, it doesn't matter whether they're working for you or if you're shut down and they're at home. If you have 500 or fewer, you can go home if you qualify for a revenue reduction from the quarter to quarter comparison, or if you have a shutdown, whether or not they provide services does not matter. Now, if you're over 500 employees and they have to be not working in order for you to use the ERTC. Okay, so steps to apply for the credit. What are the things that you should be thinking of and doing? If you have a shutdown, that's definitely when you need to start thinking about this and determining that beginning and ending period based on that. The other one is, do I have a decline in gross receipts? So one thing I would say is you should go pull your financials from 19. You probably already pulled them a few hundred times for PPP, and take the quarterly revenue and compare it to your revenue quarters in 2020, just to see if you decline. And then start comparing it to 2021. So you can keep track of whether you qualify or not based on the percentage of reduction. Now, there is a difference in gross receipts for ERTC versus PPP. And I only bring this up because so many of the people that I work with have been so focused on PPP, you might miss this rule change. So for gross receipts in the PPP realm, you didn't have to include investment income, like if you had a capital gain. Well, in gross receipts for ERTC, you would include it. And for some companies that may not make a difference, but for others, if you sold something that you had a capital gain and that would have to be included in the gross receipts, that might make a difference for you in that calculation. Then you report your qualified wages on the employment tax return. So you file your form 941, you report it on there. Now, if you do it yourself, you are going to really have to keep track and make sure that your accounting software is keeping track of that to report it on your payroll forms for you. I would keep track externally too, monitoring, your per employee maximums, who the employees are during that period, who's working, not working, if that number of employee threshold applies to you. And then you also need to remember that any owners or those who are related to them, they are not eligible. So you would not be able to get a retention credit for them. So just some things to keep track of. It's better to keep track of it as you're going than trying to do it at the end. If you use a payroll company, I would go to your dashboard with that payroll company. Most of them have documentation out there, instructions on what you need to do if they need to be accruing this for you. And you definitely need to make sure you're notifying them that you will be doing the ERTC, because they need to be able to include that in your 941 when you file it at the end of the quarter. So I would definitely do that. One of the new things that they put in with the 2021 credit, you can use Form 7200 to, which is the same form that they use for the FFRCA, the paid leave. If you need to claim that credit early, you can use that advance payment form to apply for early if it's related to the 2021 ERTC credit. And then, we are still waiting. Jackie and Kim were both talking to us, to Ann and I, and we've been checking the ERTC website for the IRS because they still have not updated the landing page with the new law changes. And they have not really released any new regulations on it. When things get passed in law, the IRS will come behind them and issue some regulation or instruction, or this is how we want you to do it. And we haven't seen anything. They issued a 941 draft form with a little bit of instruction in it, but I'm pretty sure, and your response to me was it was pretty weak. We're hoping that they're going to come out with more clear, definite, defining steps on if you qualify in 2020, what should you do? I'm pretty sure you need to amend those 941s for that year, but we're waiting to see what they say. We had a lot of people at the end of January asking us, should we go ahead and file our 941 for the fourth quarter? Or should we wait to add it? And by all means, you need to make sure you file timely with the payroll reporting. The IRS tends to be much stricter and stronger about payroll returns being filed. I don't know if many people on this call realize this. You may not. When you sign that payroll tax return, there's a little bit of personal liability that goes to that because you're the signer of that return. The IRS is going to come back to you with questions. So I always make sure I get them filed timely. And then amending a 941 is not the hardest thing to do. It's very once you know the steps, it's pretty easy to do. And then there's a link on the page right here where you can find more information. It's the fact page that Ann and I are using when we have questions. And either of us are happy. We'll make sure you guys have the slides. This is a nice chart that Ann's group created. And it gives you a side-by-side of what is applicable for 3/13/2020 to 12/31/2020, and then for the 2 quarters in 2021. And I do think Ann made a good point earlier about, this is what they've passed right now is for the first 2 quarters. It's very possible, depending upon how this year goes, they may extend it into the end of 2021. So I would be watching for that, especially if there isn't another draw on PPP. That would probably be a good opportunity for you to use the ERTC credit. So these are all the things that we have just talked about, and they put it in simple, easy to compare. And this is kind of the schedule that I keep in front of me when I'm trying to look at the employer to figure out what are they eligible for and what can they do and take advantage of. Now I'm going to talk a little bit about, and I'll probably have Ann jump in. When you have the ERTC and especially the PPP, those are 2 different, I call them spigots of aid that are coming out to us from the federal government. There's also the FFRCA, which is the Families First, the paid leaves. If someone has COVID or has a child they're caring for, that you could also be getting a credit for on that 941. You have to be careful about the wages that are being applied towards these credits, because you can't use the same wages. They do not want us to double dip, which is basically a rule the IRS follows pretty, evenly. So they're alike but different, PPP and the employer retention credit. They have different qualified periods. PPP, you're allowed to use up to the 24 weeks. It started with 8 weeks, and then they came in and they changed it to allow you to go up to the 24 weeks. Whereas the ERC uses quarters or a shutdown period. So if your business is shut down, and they also have different gross receipts thresholds. So the 50% for the employer retention credit for 2020 for revenue drop, or it's 20% in 2021. Whereas for the PPP round 2, it was if you had a 25% drop in your gross revenue, gross receipts. And, the gross receipts are different. We talked about that. It probably would have been nice if they could have kept the percentage differential the same to make it easier to figure out what we're calculating. But for some reason, when they wrote each of these, they wrote them differently. So it is a little different. And I have some clients that are getting confused with it because, I bring up the gross receipts test and they aren't sure which one we're talking about. And they do have different qualified wages. They have to use different wages. So we call this playing nicely in the sandbox. The same payroll costs cannot be used for both the PPP and the ERC. Some organizations should have enough payroll costs to use both. I've done a few applications for forgiveness where they had way more than enough payroll costs to cover what they took in PPP. And before the law change at the end of December, we were telling them, instead of going through the burden of having to go pull all of the additional costs for the non-payroll items, if your payroll costs cover it, then you should just use those to cover the loan amount. Well, now I feel there's a little different, because if you can save some of those payroll costs to be able to split them between the PPP and the ERTC, I would say now it's worth your time to go and pull your other, you use 60% to cover the PPP for payroll, and that other 40%, use those non-payroll costs in order to have enough payroll that's freed up that you can do the ERTC with the payroll that's left over. That's one strategy. I know in our office, we held off on doing some of the forgiveness applications if our clients were saying, we want to do the ERTC because we really needed to evaluate it more. And I mean, everybody still has time to do those forgiveness applications. And some entities may need to await clarification on whether excess payroll costs included on the PPP loan forgiveness applications can count towards. They may come back, and that's kind of what I've been waiting for. On some of those applications we did in November and December, they missed that opportunity. I have a feeling they're going to come back and make a decision that if you had excess payroll costs and you happen to put them on the application, but they weren't needed to qualify for forgiveness for PPP, that you will be allowed to use those excess payroll costs towards the ERTC. They haven't said that yet, though. In my mind, it would make sense for them to do that, but I don't always, they don't always follow what I think they should do. So there are some ordering rules, right? So if you have an employee who has a child that has to be out of school or out of childcare for a COVID-related incident or exposure, there's the first family relief paid leave that they can take. That is the first in the ordering, okay? So that trumps anything. If you had PPP funds and those people were paid, those are the wages you're using for your PPP application, you have to back out that FFRCA, those wages, and not include them. So that, because you can't count them twice. You've already gotten a credit for them on your Form 941. So after the paid leave credits comes the ERTC credit. So and then after that is the PPP. Now there is an election that can be made. We're looking for more guidance to come forward on that, and we should be seeing that soon. They did say within 30 days of issuing the law or enacting the law on December 27th. And I don't think we haven't seen anything yet. So, you know, the 30 days was a nice gesture, but it just takes them longer to be able to turn some of this stuff around. So what we would say is, you know, that PPP money for round 2, you should probably consider going after that first. And I know most of you, if you were eligible for a second draw, you probably have, and that's a good thing, because that's a certain pool of money and it has a hard end date of when you can apply for those funds. And you want to ensure you get the PPP round 2 money you're eligible for before we get to that date. And then when you're going into 2021, you're going to want to look at layering that second round of PPP with the ERTC. You know, we personally want to feel comfortable and have more regulation out that tells us that we can do that, but we think that's a possibility. And so it's something you can evaluate when you're going to do your 941s at the end of the quarter. So I am wholeheartedly expecting a slew of phone calls as just when tax season ends on April 15th, up to the filing date for those 941s for the first quarter on April 30th. I have a feeling I'm going to have an extended tax season figuring out some of these ERTC credits. And, you know, if you can't get it figured out before the first quarter has to get filed on April 30th, 941s can always get amended. That is always something that is very doable. Don't miss your deadline date. Get it filed the best that you can, and then you can go back. And then going into 2020, do the evaluation, see if you are eligible for the revenue reduction in those quarters, and you will have to amend the Form 941. The thing you're really waiting for is if you had PPP money, how do I split those buckets up? And what are they going to allow me to do if it's during the same time frame? So hopefully I'm pretty sure Ann and I get up first thing in the morning and check the FAC website for ERTC on irs.gov. I'm sure you don't want to be as dorky as she and I are and do that every day, but we're hoping that they're going to be issuing more regs and getting more information out to make it certain what we can do. I would say if you know you want to do the ERTC or you know that your revenue qualifies, you may want to delay doing your forgiveness application. I've had a few clients do that because you may want to reduce that payroll number that you're using to get forgiven. And it may change the decision that you're making and qualifying for that. So, Anne, do you have anything to add to that? I know I kind of went over it pretty quickly and you see.
You did great. I just want to run through just a few things that while you were talking, I was answering a few questions, and I think we should just address a few questions that did come up. Just a reminder, somebody did ask if full-time means 30 hours or 40 hours. And for some reason I hit the button that we would answer it live. So I wasn't able to type an answer, but it is 30 hours. So when you're trying to decide, do I have, over these 100 or 500 limit relative to the rules on employees, it is a 30-hour week. Here's your measurement period. Another thing that came up that, where do I claim this? It is the payroll credit. So it's not an income tax thing. This is not something that you wait and do later. Other retention credits are usually income tax related. This one's not. It is a payroll credit. So it does go on your 941. And as Christy said, it can be amended. Yes, PEOs qualify. A good question that we have really had to look into is, do you use cash basis financials or accrual basis? That answer is different for PPP and retention. For retention credit, it is supposed to match your tax return. So it's supposed to be the definition of what is used on your tax return. So if you are accrual basis for tax, you are accrual basis for retention. So you need to make sure that when you're running these numbers that you're trying to, tie back to your tax return. Obviously, if you haven't finished 2020, you can't. But I had a local nonprofit that we were trying to help, and they qualified. They had a reduction, and I said, I just want to see your 990. I need to make sure we're tying back to that return. And they forgot the sports park, right? They just completely forgot a whole division. And so we even had the right method of accounting. So just make sure for retention that you're using what you would turn in for your tax return. And that typically just depends on, you open up your tax return. If you need help, we're happy to look, but it should match what we would put on your return. No, owners do not qualify. So the idea is you're retaining people, not yourself. So you don't qualify and anybody related to you. So if you have kids, wife, the relatives, and the definition of relatives is out there. While the frequently asked questions are not up to date, if you look, there's a big yellow box, and you can see I'm just waiting for that yellow box to go away. But if you go to IRS, the link in the slides, there is a frequently asked question, and at the beginning of every one of those is a big yellow box. When that yellow box goes away, these are final. That being said, if you understand this presentation today and the qualifications we made about the differences between 2020 and 2021, you can still gather information needed that you are all asking in such a good way relative to how many hours, what is shut down, what is, what are qualified wages, what method of accounting. All those answers are there in the Q&A and likely won't change, right? Most of the rules are already set and answered there. The ordering rules, just don't forget ERC does come first, PPP second, unless you elect. It is not clear what you do about all those people that already had mailed off their forgiveness applications. We suspect that they will have some sort of provision, but we don't know. But ERC does come first just after those COVID paid leave. If you do not know what COVID paid leave is, go on CRI's website. There's, I think, another webinar. Unfortunately, I think I did it, so you'd have to listen to me. But it does talk about these paid leave credits. That's not the topic for today, but if you do have people that were out with COVID or caring for others with COVID, there is more there. For payroll, they will pay you to pay your people. It was something that was required in 2020. It's optional in 2021. But you should be aware of what paid COVID leave credits are if you don't know. How long? Somebody said, well, I'm really confused about the measurement period. Remember, if you were shut down, it's when you were shut down. If you meet the gross receipts test, then it is the quarter for which you have a drop in gross receipts of 50% for 2020 or 20% for 2021. It automatically includes the very next quarter until you go up above 80%. So if you're curious about when it ends, let us know. But you do have to run those gross receipts tests if you weren't shut down to make sure you know kind of what qualifies and for how long. It's different than PPP. I think that is all on Q&A unless more have come in.
And Jackie, do you see any other Q&A?
There are. So rather than you all having to look at the bottom of your screen, Anne Marie and Christy, I'll go ahead and read the couple that have come in additionally. And so the first is a question about the thought that you could file the form 7200 and get a check back instead of doing 941. Do you have an answer on that, even though I didn't truly ask it as a question?
So I can answer that. You can file the 7200 to get the credit, but you still have to report it on your 941. The 7200 is just getting an advance payment for it. It still has to reconcile to that 941 when you file it at the end of the quarter. It's just a way for you to get the refund sooner. But they are going to look for that filing to see that you have all the proper information to qualify for the credit.
Thank you, Christy. Another has come in regarding the 941, saying that the Form 91 tax liability is less than the wages, so the credit should result in a refund. Is the refund provided by a payment from the IRS, or will it be used towards future payroll tax liability?
I think you get to choose, just like if you have a refund on a normal 941, you can apply it forward. It's cash to you either way. Or you can choose to get the check sent to you. I will caution you though, that if you apply it forward to future liabilities and you use a payroll company, you need to make sure, that they're applying it forward and they're not taking the payroll tax from you. They're using that credit. I have seen a few 941s where we carry the credit forward quarter after quarter because we don't know how to use it up, which is basically not paying the tax in on the future period. So it can get missed.
Thank you, Christy. A question coming in on the two tests, via the shutdown versus the decline in revenue. If you meet both of those tests, does it matter or which one applies?
I would use the decline in gross receipts because most likely that decline in gross receipts is longer than when you were shut down. Certainly, look to your shutdown date. I have a client, a restaurant. Okay, he was shut down, so he qualified. He had a decline in gross receipts, so he qualified. But we had a PPP as well, and so we had a chart of, okay, what is the PPP date? What is the ERC date? And what is the shutdown date? And it's just a matter of, which one is longer. Most likely you can overlap. Just know, and I know that we had it in the slides, the retention credit, if you qualify in Q1 2020, it really did not apply until 3/13 of 2020. I don't know if we said that or stressed that, but you don't look to anything before 3/13/2020 at all. So just be aware of that date. But most likely your gross receipts, if you meet those tests, that's going to give you the better.
Thank you. And a question just popped in, and I think we briefly touched on this, but we've had so much detail. A question about, are the wages still deductible on the federal tax return?
No, that is in if you go to IRS Q&A number, I think 85. That early on. Question 85. No, you can't deduct. If you get a credit for something, you can't deduct those wages. So this is a little different than PPP. There is an add back for probably the credit portion. So if the qualified wages are 10 and the credit is 70%, most likely the $7 grand is the add back.
Thank you. I certainly will wrap it up at the very end, but Christy and Anne Marie, anything finally that you would like to mention on today's webinar?
Well, I just want to thank Anne. She's all the way in Panama City. And I said, hey, I know you wrote this article long ago in the beginning. Can you please come in and help share with us what you understand? So I really appreciate on February 25th during tax season that she took the time out of her day to help us and to share with us what she understands and knows. She is much more of an expert in it than I am. And I will be going to her with my questions. And then in that regard, anybody who's on the call who has questions or just, needs to be pointed in the right direction, please feel free to reach out. For me, I just want to make sure people are getting to take advantage of it if it will help them. And my big thing is making sure we can keep people employed and continue to work and help our small businesses at the same time. So if you need help or you're trying to figure something out, please reach out and we will do our best to try and point you in the right direction.
And Marie,
Yeah,
anything
Christy, and
yeah.
thank you so much. She saved the day with me on some opportunity zones. So anybody that doesn't know about opportunity zones, I don't ever want to call anybody but Christy. So thank you all. Thank you for the opportunity. We're happy to help. And just like she said, want to make sure you're aware and aren't afraid to take advantage of the programs that are available to your business.
Yes. And I put our contact information up on the screen, so and it'll be in the slides too if you want to reach out.
Thank you all so much. And in closing, I wanted to give recognition to Carr, Riggs, and Ingram as well for their platinum level investment in the Manatee Chamber. We are deeply appreciative of that long-term commitment of support to the Manatee Chamber's mission, and Christy service for many years on our board and executive committee as well. So thank you for your engagement at such a high level. Thank you again to our annual webinar and seminar sponsors, LaPensi Plumbing, Pools and Air, and Veritas Pest Management. Christy and Anne Marie, thank you so much. Be well, and thank you, everyone.